Hey everybody, Chris here. Thank you for purchasing this video newsletter. We are going to cover such a broad range of topics when it comes to investing that after this course, you are going to be a much more well-informed individual investor. And this course is for individuals and also professionals who manage client money for a living. So it has something to offer everybody. I've been investing for about 16 years, and you do not have to make the same mistakes that I made. And after investing for that time, I've figured out what works and what doesn't work. I've studied all of the great investors and even talked to a lot of great investors and a lot of famous money managers and mutual fund managers. So what you're about to get in this video newsletter is pretty much what all of the professionals do and how they invest. It takes more of a long-term value investing approach. This is the one confirmed way of investing that makes money with the least amount of risk. Anybody could put on a huge, highly leveraged trade and make a big trade and make a lot of money, but the sustainability of doing that is very low. Making profits year in and year out like that carries a great amount of risk, and it's a risk of blowing up your account and going broke. Whereas what you're going to learn in this course is how to be a value investor, how to buy pieces of businesses and be a long-term investor and do it with the least amount of risk. The risk you're taking is pretty much less riskier than buying bonds. And you'll see that how buying bonds over the long term doesn't really do much when it comes to beating inflation. Stocks over the long term is your best investment vehicle. So we're going to talk about such a range of topics about how to read company balance sheets, how to pick certain companies that have sustainable competitive advantage, what to look at in their financials, how to even purchase them. Do you just purchase them through a broker? We'll talk about getting the stocks registered in your name, dividend reinvestment plans, and we'll talk about so many subjects that you're going to walk away from this course being a much more informed investor and knowing more than 99% of the investment public. So stay tuned. You're going to have a great time. It's going to be a great journey. I took a lot of time doing this newsletter. It's been in the works for a long time now, and I'm really happy to get this product out to everybody. So many financial planning books that I've read and investment books, it's more in the aspect of financial planning. Basically just says, okay, own some mutual funds, own a little bit of this, a little bit of that. But it really never teaches you how to invest in individual companies. It's more about just, retirement planning, which really isn't good enough in this day and age. In this day and age, you have to be able to manage your own money and make decisions for yourself. Just keeping your money in, say, some mutual fund and even an index fund, and we'll talk about indexing and the pros and cons of that. But you really need to have full control over your money, because if not, a lot of your money is going to be siphoned off in the form of fees. And most of these mutual funds that people invest in, they really don't even know what the mutual fund manager is investing in. So now you're investing in a product that you don't even know where your money is. So then the first sign of a market downturn, you might panic and sell out. And the reason why that's dangerous is because usually people sell out at the bottom, and they sell out at the bottom is because they don't know what they own, so therefore they don't have the confidence to hold through thick and thin. So we will show you that if you know how to value your own companies and you own a portfolio of individual companies, when the market goes down, you'll actually embrace it and want to add shares to your portfolio of certain select companies, and you'll feel much more confident holding your portfolio over the long term in good times and bad times, and the bad times will be welcomed because it'll give you a chance to add to your positions. So stay tuned. We have so much material to cover. Everyone's going to learn a lot, and it's going to be a great journey. And get ready for the videos coming. You guys are definitely going to learn a lot. One of the most important concepts when talking about investing is not only compound interest, which a lot of books talk about, and rightly so, it's very important, but the destructive nature of taxes. And what a lot of people do not realize with taxes is they never visualize how destructive taxes really are. And I will show you an example right here. And when this example is showed to many people, they actually don't believe it, and they end up computing the math themselves. And the end result is startling. If we take $1 and we double that dollar every year for 20 years, and then at the end of 20 years, we just pay a long-term capital gains rate of 15% on those gains, the end result you're left with is $891,000. So if you take $1 after the first year, it turns into $2, then to $4, then $8, then $16, then $32. And you'll see like in the 17th year, it's about $65,000, then $131,000. Well, after 20 years, you're left with a little over $1 million. So after the 15% capital gains rate, you're left with $891,000. Very interesting, a lot of money. Now do this same thing and double your money every year, but sell at the end of the year and then pay a 35% capital gains rate and keep selling at the end of each year. So after you double your money, after 1 year, you're left with not $2, but only $1.65. Then after the second year, you're not left with $4. You're actually left with $2.72 because you're paying that short-term capital gains tax each year because you're selling instead of being a long-term holder. Well, after 20 years, instead of having $891,000, you only have a little over $22,000. That is the destructive nature of not only paying taxes, but foregoing that money to work and compound for you in the future to build more wealth. So there's an opportunity cost that is lost. It's an extremely amazing exercise when you do it and you actually see it in front of your eyes. So basically about $850,000 or so is going to the U.S. government. And the U.S. government loves when you trade in and out of stocks. So now, of course, you're never going to have a stock that doubles every year. This is just to illuminate the disparity in doing things, becoming a long-term holder or trading a lot more and selling after each year. You know, even somebody that doesn't trade, somebody that holds a stock from maybe 8 or 9 months at a time. So they may think they're a long-term holder, and then it kind of goes up a little, and maybe they're like, all right, I'm going to sell. They may think they're a long-term holder, but you see by this exercise, even just selling once per year and buying a new stock, just look at the destructive power of what this does. The trick is to find businesses, and this is what Warren Buffett talks about. The trick is to find businesses that are pretty much forever businesses, businesses you can hold for an extremely long time while just reinvesting dividends but never selling the underlying capital stock that you bought. And this is why, because over 20 or 30 years, you could compound your money into an extremely significant amount. And the beauty about the first exercise of becoming a long-term holder is you don't have to worry about what the market ups and downs are doing. You don't have to worry about timing in and out of markets. You know, if you owned a business or if you owned a restaurant, would you sell your restaurant because some bad industrial production numbers came out of the Eurozone, or because of the Russian ruble was weak, or the US dollar is strong but it's weak today, it might be weak next month? I mean, would you sell a great restaurant that you owned? No, you wouldn't. So why would you sell a stock or a business that you own? And the problem is that there's a quotation put on stocks every day. Most people make more money with their house than stocks. Why? Because there's not a quotation on their house flashing in front of them each day telling them how much their house is worth. Like Warren Buffett used to say, he's like, if I owned a farm, And he's like, there was a farm channel and it said that it was going to rain today or be sunny. I mean, would I sell my farm because, the farm channel said, we're going to have a drought for 6 months? He's like, it's crazy. And basically what he was saying was that people sell their stocks by watching CNBC, and they see that all these ups and downs and these economic numbers that come out, unemployment numbers, and it forces people to go in and out of stocks. So with this newsletter also, we're going to talk about ways that you could eliminate that risk of just logging into an account and selling your stock and then buying it back. We'll show you about how to buy stocks directly through a transfer agent, dividend reinvestment plans, how to buy stocks through brokers, and then you have them transferred to the transfer agent, and then actually taking delivery of the physical stock certificate, keeping it at your home or a safety deposit box. This way, you cannot wake up one morning and log into your, say, Scottrade or E-Trade account and sell your stock. Most times people log into their account, they sell their stock, and then at the end of the day or in like another 1 or 2 days, they regret their decision. So having the physical stock certificate at your residence makes you become a long-term holder. And when you're a long-term holder, you're able to perform this miraculous compounding exercise and put it into use in the real world. And this is how real wealth is built over the long term. So if we combine this with picking the right companies and stocks and being a long-term holder, you are on the road and the right direction to becoming a great investor. And it doesn't take a high IQ to make many gains in the stock market. You're just buying a stake in somebody else's business. And that's really all it is. And it's not complicated. So many people try to complicate the stock market and investing, but in actuality, it is actually one of the most simplest concepts and simplest ways to make money. But most people cannot do it because they are usually swayed by the financial media, and they do not understand the destructive power that taxes have on your portfolio. It's not about timing the market, the ups and downs, the wiggles, buy low, sell high. It's not about that. It's about time you spend in the market, how early you begin to invest. What you're looking at on the screen now is basically two investors, Rick and Mary. So let's say we'll take an average rate. Let's just take a 10% return per year. Let's say that Rick, at age 19, invests $2,000 a year. And he does this until he's 26 years old, and then he stops. He doesn't invest one more penny until he's age 65. And you see here just on the chart, it goes from age 30 and it skips to 65. I still computed everything with the years in between. I just don't show it here because I want to be able to fit the chart on the screen so you guys could see it. But let's just say he contributes from 19 to 26, just $2,000 a year, then stops. Rick will have over $1 million. Now, Mary, on the other hand, waits 8 years. She doesn't start at 19. She starts investing when she's 27 years old and starts putting $2,000 a year. If Mary contributes $2,000 a year, even if she contributes $2,000 all the way up until she's 65 years old, she still will not have as much as Rick. She'll only have $883,000. So you could see the power of investing early. And you might not believe this, but do the math for yourself and you will see how, someone like Mary could invest for over 30 years, yet somebody like Rick could only invest for 8 years and have a couple $100,000 more at age 65. Now, many people who purchase this newsletter are not going to be 19 years old. They're probably going to be middle-aged individuals, maybe with families, maybe even with grandchildren. So you may say to yourself, well, what good does this do me? I'm not age 19. Well, it does you a lot. It's very important because you could use this for your children or any of you that even have grandchildren. You could maybe start a little fund for them, open up a little account with Vanguard in their name, and just contribute $2,000 a year. And maybe they're 5, 6, or 7 years old, and you contribute until they're 20 years old. Or maybe at their 18th birthday, you stop. And then you put the account in some kind of trust and you make it so that they can't touch the money until they're maybe age 40 years old. They will have so much money and so much wealth just from you investing that little amount. So yes, this is very important to know this, even though you may not be able to really use it because you're much older. But for kids and grandchildren, you could really create some good wealth for them and get them on the road to doing right things. So, when I first looked at this chart, I was amazed. I could not believe it, how you could only invest for 8 years and then invest nothing and have that much money at age 65. I mean, I really couldn't believe it. And, life expectancies are going to be so much more longer, say, for your grandchildren. I mean, there's even talk about the average age that your grandchildren might live to will be, over 100 or even up to 120. And this is average age. So, it could be scary running out of money if you don't save enough and invest enough when you're younger. And if you don't plan for retirement the correct way. So this is definitely something you should do either for yourself if you're young, start investing early, or for your children or grandchildren. So very interesting chart. And now you see that it's all about the amount of time in the market, and it has nothing to do about timing the market. So why are index funds not the best strategy? Well, the main thing is costs. Even on an index fund of a portfolio of, say, $500,000 at 0.04%, which is what a lot of Vanguard mutual fund fees are, that's $2,000 a year in fees. And remember, this 0.04% is on the whole account value, not just the gains you make for the year. So it's on the whole $500,000 portfolio. So if you're paying 1% fees like many mutual funds charge, this translates into $5,000 per year. So if you never learn how to invest yourself, you will always be paying this huge chunk of money every year. And it may not seem a lot now when you're maybe just starting to invest, but as you build wealth over the long term, it's going to be a massive amount of money. There's also no rule that says Vanguard has to keep fees down forever. If Jack Bogle dies one day, the people who run it could easily change the culture of the company. Also, with indexing, you will never truly own an undervalued portfolio, and there will always be more risk in your portfolio. If you continually buy great companies after market corrections and hold 10 to 20% cash at most times, you will always be in a position to add to your portfolio. If you're 100% committed to an index fund, like many people with these 401ks are, then most of the time you really do not know what you own. It's like owning every store in a mall. Most of the stores are crap, yet you have to own those crappy ones to get the exposure to the good ones. Picking individual stocks keeps your portfolio much more simpler. There are non-existent fees, and most importantly, you can take the position of the stock certificates and have stocks registered in your name, which is a huge thing that we'll talk about later. You never have to worry about no SIPC insurance or some broker going under and liquidating your portfolio, John Corzine style, and losing everything. And we'll talk about this later, but this is a huge concept to understand, to take possession, have the shares you own registered in your name. There's so much issues right now about solvency of brokers. And, what's going on? Is my broker, what if my broker goes under? And this SIP insurance, most of it's a scam. Like, a lot of times there's rumors about, and it's not even rumors, this is true. I mean, this is from Bloomberg. The SIP insurance, somebody lost their money through a brokerage firm because it went under, and they thought the SIP insurance was going to cover the money. And the SIPC actually turned around and sued the customer. And then the customer actually had to pay the SIPC insurance fund. Try to Google that story. It's incredible. And, what happened also with John Corzine with MF Global. They went into individual accounts and just liquidated the assets. So you could say, yeah, I own stocks that I'm not going to sell in a market sell-off if something collapses. But the broker could actually go right into your account and sell things without you knowing and raise cash and then just, wire the cash to JP Morgan like they did. They did this exact thing. If you own the actual stock certificate or you own the shares through the transfer agent in your name, you will never have to worry about this happening. All right, so what is a stock? A stock is just part ownership in a company, plain and simple. I mean, don't let anyone tell you otherwise. If you own a company and you own 100% of that company, you own the future cash flows to that company. Well, that's all stock is. You're entitled to the future cash flows of that company. So if you own, say, a couple shares of a company, then maybe you own 0.00001% of that company's future cash flows. But it's still part ownership in a business interest. Now, the wealthiest people throughout history they own the means of production. Whether they own a 100% interest in a business or through shares like Warren Buffett, they're entitled to the future cash flows of the company. And that's why one of the main things we'll talk about when I show you how to read company balance sheets. The main thing to look at first is if a company is making money. That's it. If you see a company reporting loss after loss, the stock price is going to follow those earnings, because over the long term, a stock price just follows its earnings line. It's plain and simple. If the company makes money, you will make money. If the company's losing money and not showing a profit for many years, you will not make any money. Now, there's different things if a certain company is showing a loss, but they have like a certain special, biotechnology drug in the pipeline that they know is going to be super profitable and be approved in the future. Well, then that's why you'll see sometimes companies reporting a loss every year, but yet they're still going up. Things like Amazon too, it reports a loss, but the overall business is making tons of money. They're just reinvesting the money and doing other things. That's different. But a company that's actually just losing money every year and it doesn't really have any plans on the horizon to make any money, I mean, you want to stay away from that stuff. Also about these like mutual funds and index funds, a lot of times with an index fund is, you're owning every business on the block. Now, if you walked into a mall, would you want to own every business in that mall? I mean, no, there's usually only a couple good stores in a mall. There's maybe like, even now, like if I go to the mall, I'll see like, all right, the Apple store is good. I go past the Microsoft mall and there's like no, in the Microsoft store, and nobody's even in it. There's like 3 people looking at a few things, if that, and 2 of those people are the workers. You go to the Apple store and the place is packed. So if you own it like a mutual fund or index fund, you'll own the Apple, but then you'll also own the Microsoft. So it's like a wash. It's like really, it makes no sense. So if you could pick individual companies, individual stocks, you just pick the ones that are good companies making money. And I'm not saying Microsoft doesn't make money. I'm just saying that you should own the best businesses out there that you can. Okay? So, this whole notion of what is a stock, it's a part interest in a business. That's it. You own the future cash flows and the future production. Now, individual stocks are also so much better than a mutual fund because mutual funds have rules. Now, when markets collapse and they go down, mutual funds have to reweight their indexes. There's rules with mutual funds where they could only own a certain percentage of their money in any one sector. So say they have to have 15% of their money in the financial sector. Well, when the bank stocks collapse like they did in 08 and 09, these mutual funds have to reweight their weighting because the weighting went from, say, 15% to 7% because they collapsed. So then they have to bring it back up to 15% and plow all new money into collapsing banks and a collapsing financial sector. So this is why mutual funds and index funds, they're just terrible because you could be an individual investor and not have to worry about any of this. So individual stocks in the end is the best thing. You will make the most amount of money with the least amount of risk. And most importantly, you will know what you own. You will not get killed in fees. Fees will destroy you over the long term. Many investors ask if they should keep a portion of their portfolio in bonds. This is absolutely not. You should never own bonds, and I'll make the case for it in this segment. First of all, bonds are what financial planners offer their clients because they're scared that they're going to invest client money in a certain period and the market's going to say collapse 20 or 30% in that same year, and then they're scared they're going to get fired. So in essence, bonds are a way financial planners hedge to keep their jobs because it lowers portfolio volatility. But what it does for client returns is it just lowers the returns. And the statistics say this. Now, since the 1920s, there's been, I think since 1926, there's 67 rolling 20-year periods. So what I mean by rolling period, like 1931 to 1951, 1932 to 1952, 1946 to 1966. That's a rolling period. All right. Now, out of all those rolling periods, 67 rolling periods, stocks have beat bonds in 65 of those 67 periods. So that's 97% of the time. And when bonds did beat stocks those two times, they beat them by I think a few percentage points. It was like hardly anything. So stocks pretty much trounce bonds over the long term. There's no need to own any bonds. They do not keep up with inflation. The real return of bonds is negative. And people may say, well, no, I could buy a bond, get a 4% rate, and inflation's 3% or 2%, so I have a real return of 2%. Well, that's not true. First of all, a lot of these bonds, you got to pay taxes on the gain, okay? Also, the inflation numbers are totally not real. And let me give you an example. They say the inflation rate is a certain percentage, but they only measure what's displayed in the statistics. Now, when supermarkets shrink the price of food, they shrink the amount of food, and they keep the same price point, that's hidden inflation that does not show up in the numbers. So if you used to buy one box of cereal for your kids for the week, say for $3, well, now they've made the cereal boxes and everything from granola bars to, orange juice used to be 64 ounces, now it's 59 ounces. It's a way that companies raise their prices without raising prices. And it's called shrinkflation. And this type of shrinkflation does not show up in the statistics. They do the same thing with real estate and house prices. When house prices were going up, they just pretty much used rents. And then when house prices were going down, the CPI was more weighted towards housing, so it showed more of a deflationary trend. But the real inflation numbers are anything but real. So bonds over the long term offer you negative real returns. There's no need to ever invest in a bond. You just should keep cash. The reason you would keep cash is to keep liquidity. Maybe if the market's been having a really good 3 years and you think that the market's due for a correction, or some of your companies that you own you think are extremely overvalued compared to a historical basis, what those stocks are trading at, then you keep cash because you're maybe hoping for a correction, and you'll buy stocks on the next correction and add to your positions. That's perfectly fine. But owning bonds, no. This is just something that financial planners sell to clients to hedge their job because it's a way of lowering portfolio volatility. So individuals, they don't really see that they're losing out to inflation. They just see I made 3% this year. Wow, that's great. No one really knows the inflation rate because the inflation rate in actuality cannot be measured. So it's like a huge sleight of hand that these planners use by putting their clients in bonds. Stay away from them. So now this chart you're looking at right here shows the historical frequency of positive returns for stocks. So this makes the case for stocks even more. So this is since 1928, and it shows that as you become more of a long-term holder of stocks, the positive returns are in your favor. So you look at the number of periods, and then it just has the percentage. So the number of periods mean out of, say, a certain number of trading a month, say, so daily returns, calendar month returns. So if you look at the calendar month returns, they were positive 640 times and negative 391 times. But as you go all the way down, you'll see during a rolling 20-year period, there's never been one instance where stocks returned a negative return. So if you hold stocks for at least 20 years or more, you're guaranteed a positive return. In the future, is that guaranteed? Nobody knows. but we're just going by statistics. A rolling 25-year period, again, nothing. So you're 100% of the time, if you're pretty much going to hold stocks for 20 years, you will make money. But even if you only hold them for 10 years, you're going to make money over 94% of the time. So this just makes the case for becoming a long-term holder with stocks. If you hold a good basket of companies, and 10, 20 companies, of stocks that you could keep adding to during corrections and hold for decades, you will come out ahead pretty much guaranteed. Now, like I said, nothing in life is guaranteed, but you look at these statistics and it just makes the case for being a long-term holder, and it makes the case for not investing in bonds.